Hi, Nathan Jennison here of the Mortgage Architects. And what I want to talk about here briefly is what everybody is currently doing in terms of the market, which is this idea that they're going to wait until interest rates fall and then purchase a home. And so the idea, it makes common sense. Like, wait, get a lower interest rate means you can afford more home, means that you'll save a lot of money and your monthly payment won't be as bad. And that's generally how most people are thinking about it. The problem is that they're all waiting for the same trigger. And when you're in a situation in which everybody is shopping at once, that creates a lot more demand and it's going to cause housing to go up even faster than it already is. Let me give you some quick peeks behind what's happening. If you took a look at the US population broken down by age and you look at the average age of first time home buyers as of 2023 was 35, then you'll see that we actually have a higher number of first time home buyers than we've ever had before. It's pretty significant. And this lasts until from age 35 to essentially 21. And then after that, that birth rate falls off. So that means that for the next 10 years, we're going to have a higher demand than we've seen in the past. What's also interesting in this is that if we take a look at it in terms of pent up demand, 17%. We have the highest percentage of people living at home that we've had since 1940 at 17%. That is a lot of pent up demand. And this isn't including first time home buyers who have outgrown their current homes and who need to upsize, but who have interest rates in the twos and threes, who are more likely to rent their departing residence than put it back on the market. This means that at the first rung of the housing ladder, the first time home buyer house is essentially not being opened up to other first time home buyers. And that's going to cause that first rung to go up in price or to move higher so that it becomes increasingly difficult for first time home buyers. Again, another reason why you want to purchase now. Now let's break down what the numbers actually look like. So if you were to purchase today and you were to do this as a first time home buyer, you got great credit, you're putting 3% down, and you're buying a $500,000 home, then you're essentially going to put $15,000 down. Your interest rate, let's just say it's 6%, which is actually what it's pricing right now in this specific scenario. Then your monthly payment will be somewhere around $2,907. This is just principal and interest. And ultimately, hey, wait a minute, why do we only have less than $6,000 of cash to close? Well, the reason being is because right now, if you're negotiating this, if you're not in competition, you can actually negotiate $10,000 of seller concessions. And I see my agents do this all the time. So yes, you can right now still get seller concessions. And what that does is it lowers the amount of money that you have to bring to closing. Now, again, this is not counting closing costs. This is just down payment, taking a look at that. And the seller concessions has to go towards overall loan costs. But the point is it reduces the amount of money you have to bring to closing. Now, in terms of, hey, let's wait around and let's purchase at 5%. Well, the difference between 6% and 5%, that's a 1% interest rate difference on the exact same purchase price of $500,000. Guess what? That's going to save you $304 a month. That's not insignificant. We're talking about $3,600 a year. This is what everybody is waiting for because, hey, you know what? Let's save on that monthly payment. That's a huge stress position for a lot of people. But here's the problem. You can't get a 5% interest rate right now very easily. So what that means is you got to wait. Let's say you have to wait a year for that 5% interest rate. Well, what happens to the house price over the course of a year? Guess what? It goes up. If it goes up at 5% appreciation, which by the way, 2023, the worst year for real estate purchases in over 30 years, we've seen between 5 and 6% year over year appreciation for the year of 2023 to 2024. That is significant. So if this house goes up by 5%, guess what? We just lost $25,000 of equity. Congratulations, you saved yourself $3,600 of interest. You instead paid all of that money to rent, which was a lot more than that. And in the meantime, you also lost $25,000. So basically, the difference is that you've already lost, and if you look at the difference in the spread between those, approximately $50,000. Now, if you take a look at the interest rate, let's just keep it at 5%. Guess what? You just lost also half of that monthly payment difference. You're now looking at about $174 difference versus if you had purchased a year earlier. But the other thing that you're also missing in this situation is now we are not getting seller concessions because guess what? You're purchasing against higher competition, which likely means you're spending more than $525,000 to get into that property because you're having to outbid somebody else. And you're not going to likely get seller concessions when you're in a competing offer situation. So you're having to bring a lot more money to actually get into this property. And what's also interesting about this is the person who purchased here at 6%, they can now refinance down to 5% or lower, and they can get the full amount of that savings because they have a lower loan amount. So again, the math does not make sense. It does not make sense to wait to purchase if you're going to lose out on a significant amount of equity in doing so. So that's what I want you to take a look at. The numbers don't make sense. Look at this more deeply and don't just do what everybody else is doing. Reach out to me with any questions. I'm more than happy to help you.